So I'm sure you've all heard the popular trading saying, buy low, sell high. But how do you know if a specific stock is at a low point or a high point? We've all been there. You see a stock, you think it's at its bottom, so you buy. But then right after you buy, it keeps falling and falling, and it ends up you didn't buy at the bottom at all, you bought the middle. This little mistake can cost you thousands of dollars, and it probably already has lost you money. What if there was a secret stock rating system where you can just simply look at a company, see a rating, and instantly know if that specific company is over or undervalued? Well, in this video, I'm going to tell you exactly how to do that, so you're only investing in companies that are at a good price and you're getting the best bang for your buck. Let's jump straight into it. Whenever you type a certain ticker symbol in on Google, like Apple for instance, it's gonna give you a bunch of key metrics for that ticker symbol, like the open, the high, the low, and the dividend yield. But what we're gonna be specifically looking at is the PE ratio. The PE ratio stands for the price to earnings ratio. It's heavily used by investors and analysts because of the great value it can present. It's usually used in most cases to see if a company is overvalued or undervalued. You can get this number by taking the price of the stock and dividing it by its earnings, or just by looking it up, which is what I normally do. Generally, the higher the PE ratio, the more overvalued the company is. So a PE ratio of 15 would mean that the current market value of the company is equal to 15 times its annual earnings. Think of it like this. If you were hypothetically to buy 100% of a company's shares with a PE ratio of 15, it would take 15 years for you to earn back your initial investment through the company's ongoing profits. That's why usually you want to look for a lower PE ratio, because it hypothetically would take you less time for you to make your money back. So I'm sure most of you are scrolling through hundreds of stocks right now trying to find the lowest PE ratio possible so you can make millions of dollars on undervalued stocks, right? If only it were that easy. Just like all financial metrics, there's always a downside. It's not as simple as just finding the lowest PE ratio. The original PE ratio is known as the trailing price to earnings ratio. This is because it uses numbers from the past. This can be a problem because some would argue that the stock market is not only built on the past, but also the future. Just because a company did good in the past doesn't necessarily mean it'll do good in the future. This can be a problem for the trailing PE ratio because it doesn't take a lot of things into account. Like, what if the company just hired a new amazing CEO? Or what if they just released a new spectacular product? Or what if they found a cure to cancer? All of this amazing news would make the stock skyrocket, but the PE ratio wouldn't be affected at all. At least at this very moment, because instead of looking at the present and the future, it's just looking at the past. That's when the forward PE ratio was invented. Unlike the trailing PE ratio, the forward PE ratio looks at projected earnings. So instead of looking at the past, we're looking at the future. But of course, there's an absolute clear problem with this. What if the estimated earnings are wrong? What if the company purposely underestimated earnings in order to beat them easier? Or maybe analysts just simply got the projected numbers wrong. There's a lot that can go wrong with the forward PE ratio, and that's why a lot of investors like the trailing one, because it uses actual numbers rather than just guesstimates. So I've listed some of the problems with both the trailing and the forward PE ratio. But what if I told you a company had a PE ratio of 10? How can you tell if that is good or not? One of the ways is to compare a company's PE ratio with its historical PE ratios. That way, you can see how the number is changing over time. This will kind of give us an example if investors are valuing the company higher or lower than normal. So say a company's earnings are down, but the price is going up. This means the gap between the two, which is the PE ratio, is getting bigger, meaning people are spending more money on less profit. Same goes the other way around. If the company's earnings are increasing, but the price is falling, that means the gap is getting smaller, which means the PE ratio is getting smaller, meaning investors don't value the profitability of the firm as much as they used to. What a lot of investors like to do is compare the current PE ratio with the long-term average. So here we have Apple's PE ratio from the past 5 years. We can see the lowest PE ratio from these 5 years was 11.69, and the highest was 41.80, giving us an average of 22 to 0.47. But as we can see, the PE ratio right now is 30.80, being over the average, which may be indicating the stock is overvalued right now. Here, Intel's PE ratio is below the average, which may indicate a good time to buy because of mean reversion, meaning the PE ratio is expected to head back to its average. A lot of investors believe that a lot of short-term volatility to the PE ratio, whether that's a bad press release or something bad happening in the short term, will merely just be a leaf in the wind and not have a huge effect in the grand scheme of things, resulting in heading back to its normal average, just like a stock chart. So yeah, there's a big dip and it may seem like a big deal at the time, but if we go in the future and zoom out, it wasn't a big deal at all, and the stock continued to head back to where it was before. So that's why a lot of investors believe if a company's current PE ratio is lower than the long-term average, it might be a good time to buy, because the stock is likely to head back to its long-term average. Alright, cool. So I can just look for companies that have a super low PE ratio compared to their long-term average, and I can make a ton of money when it returns back, right? Well, again, it's still not that simple. So yeah, it's great to know how a company's stock price stands compared to its past, but you should also be comparing that stock to others in the same industry. Let me show you why. So say if we have stock A trading at $30 and stock B trading at $20. So which company is more expensive? A new investor might assume stock B is the better value because it's the cheapest. But this isn't necessarily true. The PE ratio can help us with this from a valuation standpoint, to tell us which can give you a better bang for your buck. So let's say these two companies are both in the banana industry. I don't know. And the average banana company has a PE ratio of 15. Let's say company A's PE ratio is 15 and company B has a PE ratio of 30. Company A is actually in a way a lot cheaper, even though its stock price is higher, because it has a lower PE ratio, basically saying we're paying less for every dollar of its current earnings. This is why it's usually good to compare a company's PE ratio with the sector's average. But yet again, it's not this simple. Just because a company has a higher PE ratio than its sector's average doesn't necessarily mean it's a bad buy. So banana company B has a PE ratio of 30, and the average banana company has a PE ratio of 15. It can still be justified why company B's ratio is so much higher. They could be earning their earnings at a much faster pace, resulting in a higher PE ratio. This is why high growth companies like those in the tech sector have a higher PE ratio compared to stocks in slower moving areas like utilities. So just because a company has a PE ratio lower than the average in its sector doesn't necessarily make it a good buy either. If a company does have good fundamentals, it doesn't matter how low the PE ratio is. That's why you shouldn't just solely be looking for low PE ratios, because there could be a reason why it's quote unquote undervalued. Think of it like this. Let's go back to both of our banana sellers. One seller is selling their bananas for $5 per banana, which is kind of like saying it has a 5 PE ratio. Then we have another seller selling bananas for $1 per banana, saying it has a 1 PE ratio. So we decided to buy the cheaper one, but as we all know, cheaper isn't always better. So when we get home, sure, the outside of the banana looks good and we got it a lot cheaper, but when we open it up, it's all black on the inside and not very appetizing. So just because something's cheap doesn't mean you should buy it. A low PE ratio could be justified by it being a bad company. That's why it's not always a good idea just to purely look for companies with low PE ratios, because more often than not, you're gonna get some bad bananas. So in the making of this video, it's almost as if I'm saying PE ratios are useless. It's not useless by any means. It can be a great way to identify quickly if a stock is over or undervalued, but it should never be used by itself. They're almost kind of like a rough gauge of a company at best. So if you truly want to see if a company is over or undervalued, a good approach is finding companies with good fundamentals, so finding bananas that are solid yellow, tasty, big, and grown to perfection. Then look between those solid companies and look at the PE ratios to see if you can find a good deal between those solid companies. Because as said before, cheaper is not always better. You should be looking for quality, then discounts. One of my favorite quotes about this style of trading saying is by Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that holds so damn true. This is just one of the mistakes I see traders commonly make. If you want to see the 6 biggest trading mistakes that keep you losing money, check out this video, because it's pretty eye-opening and you're probably making some of these mistakes. Thanks for watching, and I'll see you guys next time.